Money Show on ET Now. This is your daily 1 hour long dose of personal finance. We get your questions and queries as well answered. That's what we'll be doing today on the show. We'll be discussing an interesting segment, the mid and the small cap funds. Now, for a lot of you and for a lot of our regular viewers, this has been one segment that has bled quite considerably. NAVs have fallen. However, the markets are now rallying. The question is the mid and the small cap fund category as well poised to take off from here? Should you consider increasing your SIPs in these funds? And what's really leading this rally? That's what we'll be discussing today on the show with Mr. P.V. Subramaniam, who will be joining us now. And later on the show, annual reports, a very important component, a piece of information delivered by companies annually, as the name suggests. But how many of you all actually peruse the annual report carefully? If you don't, you need to stay tuned to ET Now, because we are going to get you a gist of how to spot the red flags that an annual report can throw up and what are the most important portions of this annual report. And finally, later on the show, credit cards. A lot of you, of course, may be having all of your credit cards lying idle in your closets or in your wallets, especially the travel credit cards, which do tend to carry a high annual fee. What should you do? Should you junk those, and should you just purely rely on the old and traditional cash back cards? That's something that we'll be talking to with Ajay Otani of Live from a Lounge. So it's an action-packed day right here on the Money Show. Without any further ado, let's bring on board Mr. P.V. Subramaniam of Subramani.com, the CEO. Mr. Subramaniam, pleasure having you with us on the Money Show today. I hope you're keeping safe and doing well, you and your family, amidst this entire pandemic. Mr. Subramaniam, we've spoken to you as well about this very topic, about how mid-cap and small-cap funds have been hammered out of shape, especially for those people, who had invested in maybe 2016, 2017. And subsequently, we've seen a big fall come by in mid and small-cap funds. However, this recent rally that we've witnessed, mid-caps have either kept pace or they have outperformed by a marginal extent, the benchmarks. So what do you make of this rally? I mean, many are calling it this liquidity driven rally. Big detachment from the economy is what everybody is calling it. So first, I want to get in your thoughts of this rally that we are seeing.
So if you ask me, I am first of all scared because I don't understand what's happening. The market thinks that the pharma companies are booming. When you talk to the pharma companies, they're saying, boss, we don't have workers to make. We don't have people to transport. And the people who recommend our drugs are the doctors, and they are not in practice. So from where the market is able to see the boom, I have no clue. So I can't see pharma booming. And somebody asked me, is the banking is the worst behind us? I said the worst is not even started, right? Because when you have bad news in the company in March and April, which means May and June, your EMIs won't go. So your moratoriums will have to work from May, June onwards, maybe till December. So if you're not going to collect money, banks are not going to do well. And if Maruti is not able to sell cars, how is the mid-cap supplier to Maruti going to make money? So we don't know what is happening. And the other way to look at it is to say, okay, write off 2021 and 2022 will be great. But I still don't know how things are going to change. For example, if you're going to come to office only once a week, you may spend more on camera and digital equipment at home and give up the car and come by Ola or Uber because you want to travel only once a week. So which means maybe small cars will sell, audio equipment will sell, video equipment will sell, your telecom companies will do well, but people may spend less on clothes. We have no clue what things are going to happen. So with so much of uncertainty, to be able to say next 2 years what will happen takes a brave man. And Mubina, chartered accountants are not brave, right?
Well, yeah, I mean, the best of the best investors obviously sometimes do fail in their prophecies when it comes to the equity markets, and very humbly as well admit that, it's really difficult to figure out what's going to happen in the markets next. But with things as they are right now, we are seeing a rally. We have seen the Nifty now just a couple of points away from the pre-COVID levels. A 45% rebound is what we are witnessing in the equity markets. In fact, today the Nifty is at 11,200. So yes, that is the scenario. Now, of course, the question for retail investors is that, look, it's happening. Now, how can I as well, jump into this rally? Unfortunately, during this entire COVID crisis, many people lost their jobs, many faced income crunches. That's why many of them had put a pause on the SIP. But now, as they sort of recalibrate things, look back at the, this tempting rally in the equity markets, the one thing that's, really shining is mid and small cap funds. Do you think that this could be a category that will lead the rally going forward as well for the equity markets, because we have seen that little bout of outperformance come by the broader markets in this time around?
I really don't know what is the rally that we are talking about. Yes, there is a liquidity rally for sure. If I was sitting in America and I had money and I had to invest it somewhere, I have a choice of putting it at 0% in US or minus 0.5% in Germany. If I don't like both of that, I may have to come to India and say, okay, 4% or 3% is okay. Which means if there is an investor who is coming in and looking for 4% and I am looking for 14%, something is wrong. Which means he can keep on buying the share at higher and higher price, and he will still get a decent dividend yield because his expectations are low. The question is, what do I do after a year or two? That is a big worry, and how many people will have their jobs also is not known. Enough 55, 56-year-olds are worried that their jobs will cease to be. Companies are likely to employ less people. Every pharma sales guy or a mutual fund sales guy used to call on 10, 12 people a day maximum. Now he's calling on 150 people on a Zoom call, right? So those things will change. Will they sack more people? We have no clue about all those things. So much of uncertainty. So right now it's a gamble. It might work. I mean, I've been a trader in the market. I know trading can work. If I see a share which is going up too fast, I also get in at, suppose the share has gone from 60 to 90, I also get in at 90, get out at 100, and then ask, a company ka naam kya tha? Because trading profits are happening. People will take profits off the table, right? So at what pay, at when will they invest, when will they trade, we don't know. Right now, the whole delivery seems to be a trading thing rather than a... So if you see Zerodha and ICICI Securities and Kotak and Indian Fine and HDFC Securities, obviously they are booming. Banking is not doing too badly on that leg. But how many people, how many auto rickshaw drivers will be able to pay the EMI? So that is something which State Bank of India will have to worry about, right? Because autos band hai. Ola, Uber, the cars are not running, right? How many Ola, Uber guys will be able to pay the EMI? They were living on hand to mouth. Now, when all the bad news hits, when will it hit? I don't think the bad news will hit before July, August. And then we will start getting the dirty numbers in SIP, people withdrawing, all those things will happen. In fact, I would think the bad news has not even started in mid and small cap.
So that means, Mr. Subramaniam, you believe that one should hold off on their before considering increasing their SIPs.
You've been running for
anywhere. In fact, I mean, let's assume if somebody has paused their SIP.
No, the question is, why have you paused your SIPs? Have you paused your SIPs because you have a cash flow problem? Then you should be paying your term insurance, your children's school fees. Get your priorities right. Pay those things. But if your cash flow is not a problem, if you are in a good job and you're getting your salaries on time, then don't change any strategy. Don't say, oh, I will pull out of US, I will pull out of China. You don't need to do anything. Wherever you're invested, stay invested, because we do not know what's happening. But if you have a cash flow crisis, if you have a chance that there's a 30% cut in salary, then conserve cash, because we do not know when it will get worse. That we are not at the end of the problem. We are at the middle of the problem or at the beginning of the problem. We don't know.
Okay, so find out the purpose of why you had, considered pausing your SIP in the first place. If you genuinely did face a cash crunch, and I mean, if you are staring at the possibility of a job loss, you need to conserve cash. And more importantly, if you have debts on your head, then all the more you need to pay down, whether it's a home loan debt or a credit card debt or whatever it is. Give that priority first, and then consider your SIPs. All right. So, okay. Another question, Mr. Subramaniam. Let's say if somebody had paused their SIPs and now, by the grace of everything good, maybe things have got back to normal. Since you are sounding a little more pessimistic on the market, since you believe that there is perhaps more trouble looming for mid and small cap funds, and for an individual, he's just getting out of the cash crisis. Do you think it would perhaps benefit him to postpone the resumption of his SIP by a few months?
No, Mubina, never. Because in saving and investing are good habits. Don't get out of the good habit. Because once you get out, then you will start spending. You may do something else with your money. Don't do that. That is a bad thing to do. If you have the money and your goals are 20 years away, this may be a great time to be acquiring the assets, because you may be getting them at a lower value. If the markets go up from here, if the markets go down, continue this, because once you break the habit, then you will not come back to it at all, because at what price will you come back and at what stage will you come back? Getting in, getting out should be depending completely on your asset allocation strategy and your cash flow permitting. If your cash flow is permitting, then don't bother. Then don't think of, oh, should I withdraw from this market? Should I invest more in this market, large cap, mid cap? Don't get into all that. You sat down, you created your asset allocation based on that. You have a 3-year-old daughter, you're saving for her education. You still have 15 years to go, 18 years to go. We will conquer Corona. That should not be a problem. We can't put a date to when will we do it. Will we do it in 2020, 21 or 22? That we don't know. But anyway, your daughter is only 3 years old and you need his money after 15, 18 years. So by the time, things will definitely improve. So don't bother about that. Cash flow permitting, continue your SIP. Cash flow not permitting, prioritize, pay your term insurance, medical insurance, school fees. That should be priority. SIP can wait. But if you have the cash flow, don't bother. Please continue the SIP.
Is now the time then, Mr. Subramaniam, to be greedy or fearful? Because like you mentioned, firstly, if you have a long-term time horizon, frankly, these blips really won't matter. Like you mentioned, if you have a small kid and you're saving up for his or her education, marriage or future, whatever it is, then really these small blips shouldn't matter. But if somebody, let's say, is looking at these market valuations and thinking, you know what, let me just put in a bit more money in the market, would you ask them to pause, be a little fearful of the market as it stands currently, or ask them to just go ahead?
Again, now it comes to how much of experience you have. For a Rakesh Jhunjhunwala or a Ramdev Agarwal, everything will look like an opportunity because they have tremendous ability to sit quiet over 20, 30 years simply because they've got other assets, right? So somebody who does not have those kind of assets and backing, for them, they have to be a little more fearful, saying, oh, I'm already 63 years of age. I do not really have too much of time for the market to recover. Then I will be a little more careful. But if you're 25 years of age, you still have a long time to recover. So please go ahead. So depending on how much of other assets you have with which you can you live with other assets for another 2-3 years, then you should go ahead. But if you're scared of equity, you just started off in 2016, then maybe you should reduce and pause because you don't have enough experience, right? So people with experience, people with knowledge, people with other sound income sources, they are different. And people with less experience and less resources, somebody who is supporting a family of 3-4 people and all that guy has to be a little more conservative with his cash. The only son of a vice president in a bank or something can afford to take a little more risk because there is always some backup available.
All right. So, just to summarize the entire conversation we had with Mr. Subramaniam. Firstly, if you're a long-term investor who's saving up for goals like retirement or your kids' education, etc., if you have a predetermined plan for, saving up for those goals, just continue with that. Don't sit to make any chops and changes based on events. Of course, you do have to do your, frequent review of your portfolio. If you do have the cash flows, continue with your SIP as is. However, if you think you are struggling on the cash flows, pause your SIPs, pay down on the essentials, pay down on the debt, and then, you could sort of look at continuing your SIPs. Okay, let's take on board some questions and queries then. Our very first query is coming in from Madhukar Sharma. He says, I have moved 90% of my portfolio to liquid funds. I'm not sure where he's moved it from. He's not mentioned that, but let's assume that he was parked in equities, but maybe he got a little fearful of the entire volatility that we are witnessing in equities, and hence he decided to move 90% of it to liquid funds, a big amount. Now he wants to know if it's the right time to switch to equity funds. Again, not exactly sure where he's moved it from, but yeah, he wants to know that if he should move it back to equity funds. Mr. Subramaniam, what would you recommend?
So many years, only one thing I learned is it is almost impossible for any of us to time the market every time. So once in a while, you may be lucky to have sold something and then the market comes down, but it's very difficult. Now he has tried timing the market and maybe he's shifted after the March meltdown, which means he must have sold at a bad NAV. So if he's now coming back, he's coming back at a higher NAV. So what purpose it served, I don't know. But yes, if he shifted out of small and mid cap and now he's sitting in cash, maybe he should shift to larger cap, because during difficult times, bigger companies with more cash flow are likely to be more stable than mid cap and small companies. Now, if he's a person who's trying to jump in and jump out, he has to be worried about transaction costs, which means an exit load and short-term capital gains. If he has made, then short-term capital gains tax. Moving in, moving out has a 10% cost these days. I do not know how much he'll benefit, but yes, if his cash flow permits him, he should revert the status quo ante and go back to wherever he had pulled it out from. If he's making a small loss, so be it. But he should be very clear that he does not want the money, because again, if the market falls, will he pull it out? He should, stabilize his mind first and then decide what to do.
Okay, all right. Well, that's very important point coming in from Mr. Subramaniam. How many years of experience you have? You may not be right in timing the market all the time. Yes, you may just get lucky maybe a couple of times, but ensure that that does not give you overconfidence, if you could call it that, when you do deal with the markets. And this gentleman, by moving 90% of his money into liquid funds, I think has tried to do that. The fact that he's moved such a huge amount, so it's a very important learning lesson as well for everybody. Don't try to time the market. Okay, unfortunately, we'll have time only to take one query today. So folks, don't worry, keep writing in to us. We'll get your questions and queries answered over the course of the upcoming days. Mr. Subramaniam, really appreciate you joining us today on The Money Show. Thank you for your time.
Thank you.
And, we'll definitely talk to you about many more topics going forward, especially since, I'm sure these are times when all the more people, viewers want to connect with you, and get all of their financial planning related questions answered. All right, we'll do one thing. We will take a very short break right here on the show, but when we return, we are going to be getting you the ABC of reading an annual report. It is the season of annual reports. A lot of you guys may have been getting emails now, maybe not posts, but emails from, companies giving you their annual report. Don't press the email. You must read the annual report. And if you think that you do not have the capability to do so, don't worry. Just the next couple of minutes, I'll be joined by Abhimanyu Sofat of IIFL to help you do that.